My name is Dru Hill. I'm a real estate broker with Keller Williams Greater Seattle. You can find me on all the social medias at Dru Hill the Realtor.
My name is Kyle Bergquist. I am an originating branch manager for CrossCountry Mortgage here in Seattle.
Hey there, my name is Nicole Kummer. I am the CEO of Next Chapter Properties, a part of Keller Williams Mountains to Sounds. Find me on all the socials, Nicole Kummer.
Hi, I'm Stryder, Meza. I'm a loan officer with CrossCountry Mortgage.
Okay, so here we are at our roundtable. Thank you guys for being here. It is November 8th. We just had a presidential election, and not just presidential, so there were, Congress, Senate, all the things. Fed met yesterday and had some news, so we're just going to discuss where we are is digested, so there's nothing about personal feelings with regards to, the election and results, just how we feel it might impact our market here in Seattle and Western Washington State. Where does that put us right now? And then where do we feel like that takes us going forward based on, who's president, what they're proposing as their policies, what the previous term looked like, and how we feel about it and where we think we might go. So that's a very simple way to get it started off. So Stryder, let's go to you because you're right next to me. Let's just start with where are we at right now? So the Fed met. I know that we'll get into as far as, rates came down 0.25%, not necessarily has to do with mortgage, but just kind of set the tone as far as what you're seeing in the market right now. And let's kind of bounce around, let's kind of go off of that.
Yeah. So I think what we've been hearing from the Fed and from Jerome Powell is that inflation is in a really good place. And that's been what's driven rates for the last several years is that high level of inflation. So we're not at 100% victory with inflation, but we are in a good place with it. And that's why the Fed is cutting rates right now. And I think we're going to continue to see that. Now, I think with a sweep of all three chambers of government, I think that there is potential for more tax cuts, which could be inflationary. Jerome Powell's been very forward with that he's going to be making decisions based on what we're seeing with inflation. So I think that while we are in a good place as far as inflation goes, that's going to be something to keep an eye on as the next administration comes in and we start seeing legislative changes, especially with the 2017 tax cuts coming to expire and potentially being renewed. So that's what I've got my eye on in the next 12 months or so.
Where are you last week versus this week, right? So is there anything that you felt has changed with regards to anything that you're seeing from before election to now or after election? Fed has met. What are you seeing right now?
Yeah, I think that in the lead up to the election, there was a lot of uncertainty. And so uncertainty causes traders to pull money out of the market, maybe hedge their bets a little bit. That drove interest rates. We were in the low 6s in September, and we went all the way over 7%, right, within 1 month. Now that the election has happened, there's just more certainty in the market, right? People can make their trades accordingly. Rates did jump in the first few hours after the election was called, but they have been falling ever since, which is interesting because some of the policies, tax cuts, tariffs, those are inflationary, and inflation really moves mortgage interest rates. But just because we've reintroduced certainty as to where we're going, and almost even more certainty by the fact that we have a red wave, right? We got the House, Senate, and the president, are all Republican, right? So we have a pretty good idea of where we're going, and we're starting to see the money come back into the market. We're seeing the 10-year Treasury trade down in yield. We're seeing mortgage interest rates as of the last couple of days trade down as well. And then yesterday with Fed Jerome Powell coming out saying, hey, we're going to be data dependent. We're not looking at policy. We're looking at the here and now, right? And their here and now is what is employment doing and what is inflation doing? And their precursor to inflation is really employment markets. And we did not have a good employment report earlier this month. Discount it however you want, right? Hurricanes, Boeing strike, whatever. They still took out 112,000 jobs from the previous months that weren't affected by hurricanes or a Boeing strike, right? So it's going to be interesting to see where we go moving forward. But I think, with certainty returning, things are going to, the volatility will decline a little bit.
Nicole, anything?
Yeah, I think just from perspective for conversations leading up to this week. A lot of uncertainty in the market and kind of, is this the right time for me to be making a large purchase, or should I hang on to this purchase specifically with those lower interest rates? Am I going to trade that for now double my current? I expect to see some of those conversations start to change, and I'm already hearing my phone in a different manner and different conversations between, hey, I'm gonna, wait to see, I don't know if I'm losing this job, or, what's gonna happen. Those conversations this week have already changed, and I'm getting a lot more, hey, how do we realistically set this in place?
Yeah. Now that everyone knows the cards that they're playing with, it's like, sweet, how do we play these? Right? Before, we didn't know our cards. And so it's like, I don't know what I want to do. I don't know how this is going to work. What happens then? Now we know. And so we can make informed, educated decisions for how to move forward best.
Yeah.
Okay, perfect. Okay, yeah, so same. I feel like the lead up of, like you said, the uncertainty of, okay, well, it's not even what's going to happen, because it's not even so much as far as like policy wise. It's just this in the air of who's gonna, for me, there wasn't anything factual, there wasn't anything that's like, hey, this person is going to do this, and so this is how I feel about buying, versus if this person wins, this is how I feel about buying. There was nothing. It's just that, like you said, just the certainty of, okay, we at least know what something is going to look like. I think especially with Trump having won, in theory, we've seen, assuming the presidency looks the same as it did his last time in office, we at least can have some data to pull from to say, okay, well, here's what that typically looked like. And I do believe it was, I think, when he was elected the first time, I think rates went up like 1.5 points.
Yeah, right, so they were at about 3.5%. And for the first 2 years of his administration, right after he was elected, they went to about 5.25%. And it was on tax cuts and trade war with China, right? As well as just friendly domestic policy for increasing the economy and spending, and all of those were inflationary. But when it didn't show up in the data, eventually the market came back around, because we weren't at 5.25 coming in today, right? Like in November of 2018, interest rates did pivot and they started coming down, and they were actually in the threes, the high threes, low fours by the time he left office, and inflation, was within a couple tenths of 1% the whole time.
Yeah, and I think that there is some of his first administration that we'll be able to draw from, but I think that we are in a fundamentally different place than we were at the start of 2016 going into now. I mean, we have, inflation has cooled off, but it is not that far in the rearview mirror. And rates are not at 3.5. They're starting off at 6.5.
Right.
So it is a little bit of a different climate. And I think especially with Republicans pulling the Triple Crown in Congress and the executive branch, tax cuts are really on the table. And I think they are going to be deficit financed, which is not great. That is one thing we did not hear a lot about this cycle, is concerns about managing the deficit. And as we know, the 10-year treasury is kind of indicative of what's happening with mortgage rates. So if we're going to be deficit financing tax cuts, we could be seeing upward pressure on rates for the next few years. So we'll see kind of how that plays out exactly. But that's what I'm worried about most as far as rates coming down, and why I'm expecting to see rates stay higher for longer. I know we've been talking about rates starting with the 5 for the last couple of years. I think that we are going to continue to be pushing out that timeline for getting to those lower rates.